Hi everyone, and welcome to the first lecture of CA Final Paper 7 Direct Tax and International Taxation regular batch. My name is CA Ronak Mehta. I'm a chartered accountant. I qualified in November 2008 and All India rank 24 in my CA Foundation exams, and I've cleared all my exams in my first attempt. I have been into teaching since January 2010. I teach the subject of income tax at CA Inter and CA Final. Most of you might have heard of me, some of you might have studied from me at CA Inter and at CA Final. So for May 23 and November 23, today I am starting with the full-fledged batch. It's a regular batch, 80 lectures, approximately of 2 hours 45 minutes to 3 hours, where we will be covering the subject comprehensively. We will be solving questions in the classroom, we will be writing the solutions in the classroom, we will be discussing the subject thoroughly and yet in an exam oriented manner. For May 23 and November 23, this batch is relevant. So all students who are for May 23 and November 23, you can consider for enrolling for this batch. Now, first lecture, you basically get introduced to the subject, introduction, basic concepts, income tax rates. But before we get into all of that, I would like to discuss some things with the students relating to your paper number 7, the syllabus, the question paper pattern, and then we'll dive into the subject. Paper 7, Direct Tax and International Taxation. This is your syllabus. You have a dedicated 30 marks weightage given to international taxation, where the number of chapters that you have to study are quite less, but you have a fixed weightage of 30 marks, and this is one area where from a student's perspective you can score if you study that 30 marks of international tax properly. Also, for people who are taking up the elective paper of international tax, paper 6C, the added advantage that you will get is the basics of international tax that are required for paper 6C. You will be studying in paper number 7. So in this 30 marks of international tax, whatever you study in paper 7 will act as your foundation, will act as your basis for expanding the subject further in your elective paper. 70 marks is your domestic taxation. Domestic taxation can be further understood, can be further divided into these types. One part of your syllabus is the computational part. Computational part is something which we have studied a little bit at CA Inter, but what we have studied at CA Inter is, as I said, little bit. Your CA Inter syllabus is approximately 40% of your CA Final syllabus. There are so many things of CA Final which are not taught to a CA Inter student for obvious reasons. CA Inter is the first level in which the student is studying the subject. So at CA Final, you have to study the entire Income Tax Act. CA Final therefore is much more complex, also very vast. Your seniors might have told you that paper number 1 FR and paper number 7, these are the two lengthy, voluminous, vast, unending papers. So first part of your 70 marks of domestic tax are those computational topics which we study at CA Inter. 5 heads of income, set of carry forward deductions. MAT is something that you don't study at CA Inter, you study at CA Final. Alternate minimum tax, AMT, now it is in CA Inter syllabus, so you get a glimpse of it. Various types of tax rates. Now, when I said computational part, 5 heads of income, at your CA Final, when it comes to these 5 heads of income, there are only 3 heads of income worth studying. There are only 3 heads of income which appear in your exams. Obviously, one is PGBP, the other is capital gains, and the third, income from other sources. Income from house property. From May 2016 to the recently concluded November 2022 exams has been asked only once, and that too in that paper it had a small weightage of 4 marks. Otherwise, income from house property does not appear at your CA final in your CA final paper. Income from salary, not asked as an independent question from May 16 to November 22. And when it was May 16, it was not this course, it was an old course. So I am including the analysis of old course question papers also whenever the old course was there, and new course as well. New course is the existing course that is going on. Of course, we are expecting another new course to come up November 23 or May 24, depends. All of us are waiting for the CA Institute notification. So coming back to what I was discussing, income from salary never has been asked as an independent question. In one of the chapters of international taxation, this chapter, double taxation avoidance agreement, DTAA, this one, you may get one or two small adjustments relating to the chapter of salaries, but they are so simple that even if you have not studied the chapter of salaries at CA final, you can easily solve the sum. So salary and house property, yes, officially speaking, they are part of your syllabus. If you look at the institute's website and you look at the study material uploaded, they do upload salary and house property ka chapters also, but from an examination perspective, it does not get asked. What is asked in your papers are these three heads of income: PGBP, capital gains, IFOS. You might observe there is one more thing which I have not written here, a chapter called as clubbing of income. You might remember in your CA Inter studying clubbing of income provisions, individual spouse, individual son-in-law, individual daughter-in-law, stuff like that. Clubbing of income also does not appear at CA final. It is restricted to CA Inter only. So CA final, computational topics, these are your topics. Then you go to the second part, assessment topics. Very little of this was at CA Inter. You had one chapter at CA Inter, return of income, which, if I can take the liberty of saying, when you were giving your CA intermediate exams, some of you, or if I can say most of you, might have left out this as an option when you would have just, preparing for your exams in that last 1.5 days. So return of income is a very small chapter. Some of you, if you're doing articleship in the field of taxation, you have probably in the last 2 years filed returns, various returns of your clients. So return of income at CA final is studied at much more depth. Then after filing return, what happens? What does the income tax department do? What do you mean by income tax department as a whole? Who all are covered in the income tax department? It is just the assessing officer? No. There is assessing officer, there is commissioner of income tax. If you are unhappy with a particular assessment done, then what do? You go for appeal. Where can you appeal? So all of that is your CA final syllabus. After filing return, there is assessment. After assessment, you can either go for appeal, or there will be revision of order, or there will be rectification of order. So this part of your syllabus will talk about all these aspects, the litigation aspect of income tax. Then comes the other topics. Other topics are, some of them are very small and therefore I have included them as a heading other topics, but by no means, please do not understand it like this, that other topics means sundry topics, other topics means small, useless, ignorable topics. Na. I've given the heading other topics because these cannot be classified as computational, these cannot be classified as assessment, but definitely part of domestic tax. One very important chapter, TDS, TCS, always is part of your paper, always. You can blindly vouch for it, whether it's the May attempt or November attempt, whether it is 2022 or 2021, TDS, TCS has always appeared in your paper. Taxation of trust, always part of your question paper. Taxation of AOP, taxation of partnership firms, these were never studied at CA Inter. CA Inter, the focus was on individuals and HUFs only. CA final, every type of assessee is to be studied, companies, firms, AOP, everybody. So this is your 70 marks of domestic tax, 30 marks of international tax. Something that is very important, which will consume a major part of our lecture time also when we do international tax, transfer pricing. Something which is only taught at CA final level, and like the other chapters that I just mentioned, you can with reasonable guarantee, with reasonable surety expect that transfer pricing will also be part of your question paper. DTAA also you get a dedicated question. The November 22 exam that just happened was a very smart and a very intelligent, a clever question on DTAA that was asked. Non-resident taxation, a very lengthy part of international tax as much as transfer pricing, and that also regularly comes up in your paper. And then there are some theory chapters where it's a question answer type of chapter and best studied from CA Institute study material only. Even the textbook that I will give you will have those theory chapters exactly from the CA Institute material only. So broadly, this is your syllabus of direct tax. Yes, it is surely definitely voluminous, many small chapters to study, and the weightage is, sometimes a student feels that the weightage is a bit disproportionate. We are studying a lot many chapters and the weightage given to that chapter is not that great, but it comes up in the paper, we have to study it. So there is a lot to discuss, there is a lot to study. How do you get your, what type of paper do you get? See this is your question paper pattern. You get MCQs, 30% of your paper will be MCQ. Paper number 7 is one of the papers where you get multiple choice question. 30% is MCQ, and contrary to what popular belief is, MCQs is actually the tricky part of your paper. There are bright chances that you may end up scoring less in MCQs, and descriptive questions you might be more comfortable. You have 30 marks of MCQs where the division, the allocation is you get 10 MCQs which are of 2 marks each. This 10 MCQs that I am talking about, they are case scenario MCQs. You will be given a case study, 2 case studies will be given. Each case study will have 5 questions, and that is your 10 questions, each carrying a weightage of 2 marks. You will have to analyze the case study, read it carefully, find small details, and take care of lot many things, do a lot many calculation to be able to answer these 10 MCQs. And these 10 MCQs which are of 1 mark each, these are individual MCQs. Individual MCQs as in they are small MCQs, 1 question, no case study type thing, a 3, 4, 5 liner question, 4 options given, you have to select one. Now I'm not saying they are not difficult, but yes, you may hope to score something from the individual MCQs more as compared to the case scenario thing. 70 marks of your descriptive questions. Now your question 1 is a compulsory question, and the compulsory question will be from total income. So at times if the examiner wants to complicate things for you, he will say total income and tax payable. Then this becomes a really damn lengthy question. Computation of total income itself tires out a student, exhausts a student, and when you include tax payable also into it, it is way too lengthy. In this total, but the silver lining, the advantage here, you can predict, and genuinely you can predict almost 70% of question number 1, because this computation of total income will have a major content of the chapter of PGBP. You will have maybe one adjustment relating to capital gain, maybe one adjustment relating to IFOS, one adjustment will be definitely relating to chapter 6 deductions, section 80C2, section 80U, and so the question is going to be lengthy, but you can predict what comes up in your question, what type of adjustments you can expect. Question number 2 to question number 6, this part you have to attempt any 4 out of these 5 questions. So 4 questions into 14, that is 56 marks, and compulsory question of 14, 56 plus 14 is your 70 marks. These question 2 to question 5, they are from your individual chapters. You may remember about 5-10 minutes ago I was saying, okay, from the syllabus you short can expect one question on TDS TCS, one question on transfer pricing, one question on charitable trust, one question on DTAA, one question on return of income or assessment topics. That is your question number 2 to question number 5. Each question carries a weightage of 14 marks. You will have sub questions 2A, 2B, at times it is 2C also. So at times it is 6 marks, 4 marks, 4 marks, or at times it is 8 marks, 3 marks, 3 marks. It depends on the question basically. And so this is broadly speaking your question paper. Question 1 compulsory, total income. Question 2 to question 6 individual chapters, that is 70 marks, and 30 marks of your MCQs. Chalo. Now let's get into our subject. First lecture, basically what I want to discuss with the student is some introduction, some introductory topics, and more importantly my focus is to make you understand, to make you remember the rates of tax. So our discussion will broadly be divided into 2 categories, introduction and tax rate. Sometimes a student asks me this question, sir, what is the difference between CA Inter and CA Final when it comes to the subject of direct tax? So dekho, one difference so you already understood by now, syllabus. There are so many topics which are not there at CA Inter, they are there at CA Final only. That is one difference obviously. Second, if you remember your CA Inter question paper little bit, then at CA Inter the focus of the question paper, the focus of the examiner, the focus of the institute was to test you on computation. We want a student to know how to compute income from heads. We want a student to know how to compute total income and the tax liability on it. Because my CA Inter student might take up articleship in a CA firm where taxation practice is there, and he will have to handle those taxation clients. So we want him to have basic knowledge, working knowledge type. He should be able to work out the tax. But when it comes to CA Final, we are expecting a student to basically know everything. Now that's probably, everything is very vague. Sir, what do you mean by everything? I mean that I am expecting the student to know the computation part also, but I am also expecting the student to know the interpretation part also. If a client calls up a chartered accountant, this is the complex situation, what will be the tax implication, what will be the tax consequences? He is basically asking the CA for an advice. The CA is giving his consultancy services. He needs to interpret the law. That's what CA Institute is going to teach you and test you at CA Final. At CA Final, your interpretation skills will be tested. You will have to interpret one section. You will have to interpret 2-3 sections at a time. You will have to read one section, maybe understand a bit of that section, but to understand it better, you will have to go to income tax rules. You will have to refer a case law. You will have to refer a certain notification. So a CA Final student is expected to be aware of all these things. At CA Inter, what you studied was something of Income Tax Act. Something of Income Tax Act 1961. This was majorly your syllabus. You used to study section numbers. Some places you used to study income tax rules. In the chapter of salaries, you had valuation of perquisite. That was rule number 3, where all the formulas are given, how to value ESOP, how to value accommodation, how to value motor car. In house property chapter, you had unrealized rent ka concept, which had rule number 4. Very few rules, very few, I would say almost negligible rules were to be studied. At CA Final, since you are expected to know everything, you are expected to study Income Tax Act 1961. you are expected to study income tax rules 1962. Wherever the rules appear, you're not expected to know all the rules, but yes, a huge amount of, or if I can say many rules which you have not even seen at CA Inter, you will be studying them formally at CA Final. Then you are expected to know circulars, you are expected to know notifications that are issued, and you are expected to study case laws. CA Inter pe to you hardly studied a case law. If you recollect, there was probably only one case law which was discussed at CA Intermediate, the chapter of capital gains, the very famous case law CIT versus Manjula J. Shah, the indexation controversy. If I can use the word controversy, actually, indexation concept had this 2 point of views available, one based on Manjula J. Shah wala Bombay High Court judgment and the other a different point of view. So case laws were never part of a CA Inter syllabus. They are part of CA Final. Because what is case law basically? What do you mean by case law? Case law is nothing but the interpretation of Income Tax Act gives you case laws. The High Court, the Supreme Court, the Tribunal interpret the section. Circulars and notifications, they also in a way help you in interpretation. They also help you in clarifying various things, clarifications. What is Income Tax Act? Income Tax Act 1961, basically that is the act. ये तुम्हारा कानून है. This will tell you what is to be done, what is not to be done, what is permitted, what is not permitted. Income tax rules. If there is already Income Tax Act, why do you need income tax rules? For one very simple reason, you can't put up everything in Income Tax Act. Otherwise, the Income Tax Act will become way too bulky, nobody will be able to handle it only. So, income tax rules basically give you the procedure part. Income tax rules basically give you at times various formulas. You are supposed to do a certain thing for which you are supposed to file a certain form. Where is it written that you have to file this form? That is written in income tax rules. It is a procedure. Income Tax Act tells you what the law is. Okay, this is to be computed like this will be allowed, this will be disallowed, this is how the assessing officer should proceed, this is how the assessee should proceed. Income Tax Act will state the law. Income tax rules will give you the procedure. The law has to be implemented like this form has to be filed, this formula has to be followed to find out market value, this formula has to be followed to find out perquisite value. Circulars and notifications will clarify certain things, and case laws are interpretation of all of this. So CA Final, this is all that you have to study. This much is what you have to study. Yes, that obviously means that it's a very vast syllabus. Now, when you say income tax, when you use the word income tax, chalo, what is basically income tax? It is a question which I would have actually posed to a CA Inter student. And when I pose it to a CA Inter student would say, sir, income tax means tax on income. CA Final student will give me a slightly more sophisticated answer. Tax on income calculated as per Income Tax Act, tax on taxable income, net taxable income. So, to put this all into technical wordings, technical language, what is income tax? Income tax is calculate your total income and on that apply your rates of tax, and this is your income tax. Now, when is this income tax payable? So by income tax is payable in the assessment year. The liability to pay, payable, the liability to pay arises in the assessment year. So for May 23 and November 23, we have the assessment year 23-24. Income tax is calculated on income. Which income? Total income. When is this total income earned? This total income is earned in previous year. So we have to study previous year 22-23 assessment year 23-24. Now mark my words, income tax is calculated on total income. I am not using the word income. I am saying income tax is calculated on total income. What is the meaning? Total income is defined in section 2. I am sure you know this, that in India every act, when you mention section 2, you are talking about definitions. Section 2 clause number 45 defines total income. What is the definition of total income? See this. Total income means the total amount of income referred to in section number 5. Comes the first point of discussion, referred to in section number 5. Computed in the manner laid down in the act. This is the second part of this definition, computed in the manner laid down in the act. So what is total income? You can't define total income as total of all incomes. No. Total income means the amount of income referred to in section 5. Now use your memory. What is section 5? Section 5 is scope of total income. And if you remember your CA Inter, scope of total income depends on the residential status. Remember something like resident and ordinarily resident, resident but not ordinarily resident, non-resident. How to decide whether somebody is a resident or non-resident? That was given to us by section 6. So, 1 minute. If you observe, I have started the process of interpretation before you. Section 2 clause number 45 tells you total income, which makes a reference, which mentions section 5. Section 5 says scope of total income. So total income means income which falls in the scope of Income Tax Act. But to decide whether section 5 applies to a particular income or not, we need to know, we must be aware about the residential status of that taxpayer, the residential status of that assessee, and that is given to me by section 6. So my total income depends on section 5 and section 6. Half an hour, 45 minutes later, I will discuss section 5 and section 5 also with you, scope of income. We'll read it from the book, we'll try to simplify it. The second part of the definition, computed in the manner laid down in the act. Now, what is this? Computed in the manner laid down in the act. When you earn incomes, there are some incomes which are covered by section 10 of Income Tax Act. Now, I'm sure if you use your CA Inter knowledge, you will immediately tell me this. Because our section 10 means incomes which are exempt incomes. So is it income? Definitely yes. Have you earned it? Yes, I have. But it's exempt from tax. So I'm not supposed to pay tax. Logically, if I'm not supposed to pay tax, it means I don't have to apply my tax rates on that exempt income. I don't have to apply my tax rates. I don't have to pay tax, which means I can easily interpret one thing here. कि भाई my total income excludes my incomes which are exempt, incomes which are covered by section number 10, because I don't have to pay tax on it. Why is it called as exempt? Why is it exempt? So there are multiple reasons. Section 10 has a list of incomes from section 10 clause 1 to section 10 clause number 50. And of course, it's not only 50, there are more than 50 incomes. But why are they exempt? Some are exempt because income tax is already paid on it. Some are exempt because the government wants to promote something, the government wants to incentivize something, the government wants to push that particular activity, that particular thing and promote it. So we are giving tax exemption. So some of them are exempt because they are capital type of incomes. Like if you remember your CA inter, gratuity up to a certain limit is exempt, lump sum pension up to a certain limit is exempt, money received from provident fund is exempt in some cases. That is all covered by section 10 only. If you actually open the Income Tax Act and you look at section 10 ka heading, section 10 ka heading is incomes which are not included in total income. Now basically it means the same thing that I have written. If you observe, I wrote total income excludes income under section 10, and the official heading of section 10 is incomes which are not included in total income. What is total income? Total income is the total income that is defined in section 2 clause number 45, and we read that 2 clause number 45 said computed in the manner laid down in the act. In the act means in the Income Tax Act. Every time in the Income Tax Act the whole word is not written, they use the word act. Act means the Income Tax Act. So Income Tax Act 1961 gives you a certain manner, a certain procedure in which you will do calculation, in which you will do computation. One of the sections of that Income Tax Act 1961 is section number 10. And what is section 10 telling you? Okay, by section 10 is basically trying to tell you okay, by this income is not to be included in total income, therefore we for simplicity say it is exempt. That means total income will not include exempt incomes. So what will total income include? It will only include taxable incomes. It will only include incomes which are chargeable to tax. Now how to decide whether the income is taxable or not? We will decide that whether an income is taxable or not using section number 5, scope of income. So we came to the conclusion that okay, for a resident person this income is taxable, but if the same income is earned by a non-resident person, it is probably not taxable. Or if there is a certain other income, whether you are a resident or a non-resident, resident and ordinarily resident, resident but not ordinarily resident, irrespective of your residential status, you have to pay tax on that income. All of that, where is it mentioned? It's mentioned in section 5. The total income will be calculated according to section 5. But once you decide that okay, these are the, let's say 17 incomes that are chargeable to tax, I can't just roughly total them all 17 put together and then say chalo on this apply tax rate. Nahi. Once you decide or you apply section 5, you will then have to follow the system of computation, and for that computation you will have to categorize, you will have to classify the income into your 5 heads of income. Where are these 5 heads of income written? Who told you that there are 5 heads? At CA Inter, the faculty would have told you income is covered into these 5 heads. These are the 5 heads, and for each head an example is given. But these are the 5 heads that must be written somewhere. 5 heads of income, where are they mentioned? They are mentioned in section number 14. Section 14 only tells you what are the 5 heads. Then each and every head of income begins. For example, salary, section 15 is my charging section. So 15 is where salary as a first head of income begins. But 14 is the section which tells you what are the 5 heads. When you total up the 5 heads, you do not get gross total income. I am pretty sure by now, as a CA final student, you are aware of this. Even if you've done articleship in audit now, you probably know this. Yes, 5 heads ka total, we have to take the total, but it is not called as gross total income. As far as calculation goes, my total income is calculated as gross total income minus the deductions under chapter 6A of the Income Tax Act. And chapter 6A of the Income Tax Act is basically deductions from section 80C to section 80U. Actually, the chapter 6A does not begin from 80C, it begins from 80A. But 80A is general theory about the deduction. It does not give you a certain X rupees as deduction, it is general theory. Deductions, this much amount is allowed as a deduction, this much is not allowed as deduction, that basically it starts from section 80C. Now coming back to what I was talking with you, this is my total income, this is the computation part. Definition said na, computed in the manner laid down in the act. So this is your computation, and in the process of calculating gross total income, I am surely, definitely taking up my 5 heads of income. I am surely, definitely not taking up incomes under section 10, but I am taking incomes which are chargeable to tax and putting them into the relevant head. Each and every head of income has its own computation system. So if I am getting 1,25,000 as income, it's not necessary that the full 125 is charged to tax. I might be able to take some expense cut deduction, and after that whatever is a taxable amount under the relevant head will be taken. But that is only 5 heads. After 5 heads, you have to give effect to the chapter of clubbing of income and the chapter of set off and carry forward of losses. I have earned the income, but I am not the person who is going to pay tax. Somebody else is going to pay tax because of the chapter of clubbing. That means this income has to be included in that somebody else ka gross total income, not mine. Reverse, somebody else has earned the income, but I am the person responsible because of a certain section of clubbing. Then that income will be included in my gross total income. So in the process of calculating gross total income, I have to consider, I have to take into account the chapter of clubbing of income also. Maybe in a particular year, I earned the income and I suffered a loss. Obviously, you don't pay tax on losses, you pay tax on profits only. But I have suffered a loss. I will not ignore that loss. Government does not ignore that loss. Government says, okay Ronak, we understand you've suffered a loss this year. Don't pay income tax this year. But it's a loss that you'll have to suffer. You'll have to recover this loss in future. So in future when you earn profits, first you set off this loss and then the balance profit you pay tax. So now there are rules and regulations created to allow the assessee to set off the loss, to allow the assessee to carry forward the loss. That is also a process. Set off and carry forward is also a process that an assessee will have to do before he finalizes his gross total income. If you can understand a bit of section numbers, gross total income is defined in 80B subsection 5. Total income is defined in 2 clause number 45, which tells us to look at section 5, and we know that section 5 depends on section 6 residential status. But total income depends on section 5 residential status and section 5 scope of income, section 6 residential status, and it also talks about computed in the manner laid down, for which I will have to go to section 14. What are my heads of income? Classify them, then give effect to the chapter of clubbing, then give effect to the chapter of set off carry forward, get gross total income, then take a deduction under chapter 6A. So if you actually observe 80B subsection 5, sorry, 80B subsection 5, just give me a minute. If you actually observe 80B subsection 5, the way gross total income has been defined, gross total income is income which is computed before giving effect to chapter 6a. Now the reason I wrote this is I want a student to understand this interpretation. Before giving effect to chapter 6a. Sir, what does that mean? Before you give effect to chapter 6a, whatever is the amount that you get is your gross total income. But that implies after giving effect to all the other chapters that are there before chapter 6a. Income Tax Act 1961 gets divided into chapters. Then in every chapter there are certain sections, and then there is a section in which there is subsection, or there is a section in which there is a clause. 5 minutes and I'll discuss that also with you. But when you say Income Tax Act, it is not just section 1 to section 298 arranged in a sequence. No, it's a bit more systematic than that. Income Tax Act is divided into different chapters. In our textbook, in chapter number 1, see this. Just for your reference, you don't have to memorize it, you don't have to study it, but you can use it whenever you come across some section which says chapter 12b, chapter 17b, chapter 4. So, arrangement of sections. There is a chapter, the heading of that chapter, and which section numbers are covered. As I've said, this is only for your reference. You don't need to remember this, memorize this at all. But like you saw, section 80b, what is it saying? Before giving effect to chapter 6a. Now what is chapter 6a and what are the chapters before chapter 6a and what all things are covered in it? That's where this table will help you to study. Chapter 1, section 1, 2 and 3, preliminary things. Chapter 2, basis of charge, section 4 to 9a. This is where my section number 5 and section number 6 are covered. Basis of charge. Incomes which don't form part of total income, exempt incomes, section 10 to section 13b. Popularly we know section 10, but that's not all. There are many sections here to study. Heads of income. Section 14 gives you the list, and then these are my heads. There was part B also, interest on securities, way back 1980s mein. They omitted that interest on securities. As a separate head of income it was there. They omitted that head of income and then they merged it with income from other sources. So, part A to part F of chapter 4 gives me my heads of income. That is before chapter 6a. So, when I am calculating gross total income, it is before chapter 6a, which means I have to give effect to chapter 2, basis of charge. I have to give effect to chapter 3. Chapter 3 is a negative chapter. Incomes not to be included in total income. So all the incomes which are there in this chapter 3, I don't have to include them in gross total income. I don't have to include them in my taxable amount. Chapter 4, these are taxable incomes. Categorize, classify them into heads of income and use each and every head of income sections involved and give effect to them, compute karo. Then income of other persons included in total income, chapter number 5, simple words called as clubbing of income. Chapter 6, set off and carry forward of losses, aggregation of income. So you are aggregating income, you are totaling all heads, and in that process if there is a loss and there is a profit, are you allowed to set off? Is it permitted, not permitted? That is your chapter 6. That chapter also you will have to give effect before giving effect to chapter 6a. That's what I meant. After giving effect to chapter number 1 to chapter number 6, whatever you get is your gross total income. And then you give effect to chapter 6a, you get total income, and on that total income you are supposed to apply your tax rates. If you observe, we started with a very simple line. Income tax is equal to tax on income. Tax means tax rate applied on income. Which income? Total income. But then now you can understand that it is not actually simple at all. It is so complex. There is a web of section numbers that you have to interpret together to be able to reach to a conclusion, to be able to do all your calculations properly. This is, if you can think of it, this is my first part of the discussion. Income tax, first part, total income. Second part, tax rates. Who gives you tax rates? Where do we come to know what are the rates of tax? Every year, February 1st, the whole of India is hooked to the television sets. Everybody wants to know what the finance minister is going to present in their budget. The budget as it is presented in the Lok Sabha, that is called as finance bill. Then that finance bill is approved by Lok Sabha, Rajya Sabha, or I should say passed in the Lok Sabha, passed in the Rajya Sabha, and then the President of India signs it. The President of India gives the consent, gives their assent, and after this it becomes Finance Act. What we are going to study is Finance Act 2022. I told you that for May exams and November exams, it is previous year 22-23, assessment year 23-24. This is the combination that you are going to study. So the question that you will be asked will be, a person is earning income in the year 22-23. What is the tax payable in 23-24? See, income, total income earned in 22-23. I am talking about this part. Total income earned in 22-23. Income tax payable in 23-24. At CA final, one thing that you will have to learn, and consciously you will have to make an effort and learn it. The thing to learn is, you will have to start discussing, start talking, start writing everything in Income Tax Act with reference to the assessment year. See, it is very easy and very convenient to understand the subject if you keep previous year in mind. In fact, in our initial lectures, I will discuss everything with you with reference to previous year, and then I will switch slowly to assessment year. All the theory that you write in your question paper, in your answer sheet, theory, all the theory that you read from the textbooks, you have to keep in mind the assessment year. Why? See, we'll get into the definition a bit later. What is previous year, what is assessment year? We'll get into that definition a bit later. But when you say that we are studying Income Tax Act 1961, what is Income Tax Act? Why is Income Tax Act created? See, as a CA final student, to be honest with you, you would already be aware about all this technical aspect. Ke Constitution of India gives power to the central government, then there is union list and state list and concurrent list. Today, because of knowledge being so easily available, almost every CA final student is aware of this. The Constitution of India gives power to the government to create a law, to frame a law. So income tax is covered in the union list, and in the union list power is given that you can impose tax on all incomes except agriculture income. Now the only value addition that I am currently going to do is to make you realize why agriculture income is exempt. CA Intermediate, we have studied agriculture income is exempt from tax, section 10(1) of Income Tax Act, because when the Constitution of India gave power to the central government in the union list, it said you can create a law to tax all the incomes except agriculture income. India primarily is an agricultural economy. Now yes, manufacturing and service sector have gained a prominence, but 1950s, 60s, 70s, 80s predominantly, and today also, we depend a lot. Our GDP has a great component of agriculture income. So agriculture income is not subject to income tax. State list covers agriculture income. So Constitution of India has said कि by the state governments have been given the power that if you want, you can create a law in your state to collect some type of tax, not income tax, some type of tax on agriculture products. But state governments also refrain from it. Agriculture income is not subject to any state tax also, is definitely not subject to income tax also. What Constitution of India said, कि you can tax all incomes except agriculture income, that has been embodied, that has been inculcated, that has been brought into the Income Tax Act also. Okay, Constitution ने बोला don't tax agriculture income. Okay, Income Tax Act also says 10(1) agriculture income is exempt. But then what is Income Tax Act? Why is Income Tax Act created? Constitution of India gave power to the central government that you can create a law to impose, to collect income tax. That means Income Tax Act 1961 is a law to charge, is a law to levy, is a law to impose income tax. And but of course, when the Income Tax Act is framed, is created, it will tell you that these are the incomes which will be subject to tax. But that's not going to be enough. We will also require the Income Tax Act to do the administration part. I'm just using heavy sophisticated words. What I'm basically saying is what I spoke with you at the starting of the lecture when I was discussing the syllabus with you. Have a look. What is your syllabus? Computation and assessment. Computation part are those chapters and those sections where tax will be imposed. This income will be taxable. This is how it is going to be calculated. But everybody is not going to be honest enough and pay income tax. So there has to be a mechanism to do administration of this. Administration is the second part of your syllabus. Assessment. Ask the assessee to file a return. If need arises, we will pick up the case for scrutiny assessment and we will tell the assessee this what you've done is right and that what you've done is wrong. So that is the administration part. Now, see this. What is Income Tax Act? It is a law, it is an act to charge income tax, to levy income tax, to impose income tax. And all of this, charging income tax, levying income tax, imposing income tax, all of this happens in the assessment year. Previous year to is the year in which I am busy earning the income. On that income, you can impose income tax in the assessment year. So when you are studying Income Tax Act, when you are writing stuff about Income Tax Act, it is important, it is necessary that you do the drafting with reference to the assessment year. And for your exams, May 23 and November 23, the assessment year involved is assessment year 23-24. So the question will tell you, you are required to compute the total income for assessment year 23-24. Mark my words. You are required to compute the total income. Earning happened in previous year. But the moment I earn the income, I don't sit and calculate it. I do the calculation in the next year. Next year is my assessment year. So the question will say you are required to compute the total income for assessment year 23-24. When you will write your solution, your heading will be so and so assessee computation of total income for assessment year 23-24. It is going to be assessment year for which you will be doing the drafting. Now, previous year is 22-23, assessment year is 23-24. So, writing something which is not great. Previous year 22-23 starts from 1st April 2022, ends on 31st March 23. Assessment year starts on 1st April 23, ends on 31st March 24. Now the reason for writing these dates. The budget is presented, the finance bill is presented in the Lok Sabha, is presented to the general public on 1st of February. And all this process, all of this gets over up to 31st March. So generally you will observe that in the first or the second week of April month, the Finance Act is ready. President has signed it. So if my previous year is 22-23, if I am earning income in 22-23 and I am going to pay tax in 23-24, when is this budget going to be announced? This budget is going to be announced on 1st February 22. Now I want you to pay attention to dates so that you understand what I am going to discuss. The budget is presented by the Finance Minister on 1st Feb 22. I mean to say that I am earning income 1st April 22 to 31st March 23, on which I am supposed to pay tax between 1st April 23 to 31st March 24. This is the tax payment wala period. This is the income earning wala period. So, what is the significance of these dates? What I am trying to make a student understand is that as an assessee, as a taxpayer, even before I started to earn income, even before that, 1st of February 2022, the government told me at what rate is it going to tax me. In the budget, all of us know that rates of tax are announced. Everybody is eagerly waiting. Will they increase the slab rates? Will they give us more tax relief, tax benefits? Will they reduce the rate of tax for companies and firms? Everybody is waiting. So budget is not just tax rates. Finance Minister speaks many things. Most of the public is not interested in the first 1.5 hour of the budget speech. The moment Finance Minister starts with income tax proposal, everybody is like, okay, let us sit up and let's understand what is this. They are hooked to the news channels also. The news that are rolling, everybody is looking at slab rate change hua, tax rate change hua, any new thing. Basically, everybody is interested in income tax proposals, no doubt about it. But that is on 1st Feb 22. The tax that I am going to pay in 23-24 on the income which I am earning in 22-23, which I have not even started earning on 1st February 22. On 1st February 22, the government is saying, we propose that we will tax you like this on the income that you will earn starting from 1st April, 2 months later. 2 months later, when you will start earning the income from April 22 to March 23, you will earn this income. You will file your return in the next year. Will you pay tax at 10% or 20%? 30% or 40%? Surcharge will be 10% or 15%. Health education cess will be 4% or 5%. All of that is proposed, is announced February 22 in advance only. So government is telling the assessee you want, you can plan your tax. You can plan using legitimate income tax sections and reduce your tax liability in a legal sense. I am informing it to you in advance only. So Finance Act 22 is for previous year 22-23. CA inter students, I generally give this stupid type of technique to tell them, see, what is your previous year? 22-23, so it is Finance Act 22. If your previous year is 21-22, it is Finance Act 21. Now CA inter student, just to make that student memorize, I give this stupid type of technique. Actually this is the logic behind it, that if it is Finance Act 22, it is for the upcoming previous year. Upcoming assessment year nahi, upcoming previous year, the year that is about to begin. Which year? Previous year that is about to begin. That is Finance Act 22. All the textbooks that I will give you, the question bank, the summary book, the discussion in the classroom will be all as per Finance Act 2022. All the amendments of 22 Act will be covered. Now, some time ago I told you, yes, we will look into the definition also of previous year and assessment year. Now, actually that's a kind of a formality, but let's discuss that also. See, what is the meaning of assessment year? See this. Assessment year is a period of 12 months commencing from first day of April every year. Check. Assessment year is a period of 12 months commencing from 1st April every year. Yes, it's an assessment year. But now if you think about it, even this is a period of 12 months starting from 1st of April. So 21-22 is also an assessment year. Now, what's my assessment year? 22-23 or 21-22? Logically speaking, both are correct. 21-22 is also an assessment year. 22-23 is also an assessment year. If I am just studying the definition of assessment year in isolation, only assessment year ka definition I am focusing, then every financial year is an assessment year. Every period of 12 months commencing from 1st April is a financial year, and that is an assessment year. So, we need to study the second definition also, previous year. Section 2 clause number 34 defines previous year, which says previous year as defined in section number 3. God knows why they have done this, but in 234 they are telling the reader, go and read section 3. And what is section 3? Previous year is the financial year immediately preceding the assessment year. Array? Assessment year is a financial year 12 months starting from 1st April. Previous year is the financial year preceding assessment year. That's why all of you are aware of this. Okay, by every financial year plays a double role. Every financial year is an assessment year also and a previous year also. The actual meaning of these two terms comes up from your charging section 4. See this. There is a word used in charging section 4, previous year. There is a word used in charging section 4, assessment year. Assessment year defined in section 2 clause 9. Previous year defined in 234 and section 3. But they are used in section 4, and when we analyze and read section 4, we actually understand the meaning of the two terms. Where any central act enacts that income tax shall be charged for any assessment year. So assessment year is the year in which income tax is charged, meaning the year in which income tax is levied. the year in which income tax is imposed. That is why this section says section 4, charge of income tax. Where any central act enacts. Central act means Income Tax Act is also a central act, but here we are not talking about Income Tax Act. In Income Tax Act only, in section 4, if we are writing central act enacts something, so we are not obviously referring to Income Tax Act. This that we are referring to is Finance Act. Where the Finance Act is enacted, brought into existence, which says that income tax shall be charged for any assessment year at any rate or rates. You remember this? See, income tax is equal to total income into tax rates. The tax rate wala discussion is still pending. I have not discussed that with you, but tax rates. So that rate ka reference is given here. Where any central act enacts that income tax shall be charged for any assessment year at any rate or rates, income tax at that rate or those rates shall be charged for that year in accordance with and subject to the provisions of this act. This act means Income Tax Act, in respect of the total income, section 2 clause 45, of the previous year. Total income of the assessment year nahi. Assessment year ke liye the word used is income tax shall be charged in respect of the total income of the previous year. Which means what are we doing in the previous year? Previous year is the year in which we are earning the income. Previous year is the year in which the income is earned. The definitions don't give you any meaning. Assessment year is a period of 12 months. Previous year is the year immediately preceding the assessment year. They don't give you the meaning. They can at best help you to create an example. 23-24 is the assessment year. So year preceding to it. 22-23 is previous year. 22-23 is an assessment year. Year preceding to it. 21-22 is the previous year. It is charging section 4 which helps you to understand, which helps you to decode the meaning of the word previous year and assessment year of every person. Last word, of every person. Provided that, now I'm sure you know this, if not, remember this. Any paragraph which starts with the word provided is called as a proviso. Some people call it as proviso. Anything, pronunciation does not matter. Proviso is basically an exception. The main thing is created. Now, if I want to create an exceptional situation, I will start a new paragraph with the words provided. Sometimes there are many exceptions created. So, the first exception created will be provided that. Then there will be second paragraph. Provided further that this. Provided further. And if there are more than two exceptions, then the third, fourth, fifth, sixth exception will be provided also. Provided further, provided also. And then every paragraph will be provided also. So a provided wala paragraph is a proviso. Sometimes there is also something called as an explanation. See this. I'll give you an example of this explanation also. See. This is section 5, scope of total income, and in that you have this paragraph, provided an exception created, subsection 1 states something, and then a proviso, a small exception is created, and then there is subsection 2, and then there is this explanation 1, explanation 2. What is this? Explanation, as the name is suggesting, it is an explanation. So it is going to explain something. It is going to explain something. It is going to elaborate something. You can't put everything in the main section or a main subsection, otherwise it will become too bulky, too weird, too much to interpret. Rather than making it simple, it will become confusing. So there is a paragraph created after the main thing is put up. Explanation. Something that I want to elaborate, I've put it up via an explanation. So I read subsection, I read the subsection, I understood it, but I had some doubt, and then I read the explanation and I said, okay, that situation, that doubt wala thing which came into my mind, the lawmakers are intelligent enough to imagine that also, and they have put up an explanation for it. So a proviso and an explanation, both are actually part of the section only, but they will help you to understand the section better. So there will be a section which will be divided into subsections. Sometimes the sections are divided into clauses also. I don't know if you've been paying attention to, but you can, rewind the lecture and see it. Section 2, clause 45. Section 80B, subsection 5. Section 5, subsection 1, subsection 2. All of these are section numbers only, but sometimes I am saying clause and sometimes I am saying subsection. So how do we remember, or how do we come to know? If you open Income Tax Act, nothing is given. If you open Income Tax Act, you are given section 5 into bracket 1 into bracket 2, section 2 into bracket 1, 1A, 2, 3, 3A, 4. So there is no clarification, there is no description given in the Income Tax Act. See, if the section that we are talking about is a list of some things. If it is a list of some things, then it has clauses. What is section 2? List of definitions. What is section 10? List of exempt incomes. So there it will be clauses, clause number. But then if there is a section which is not a list of things, they are provisions definitely, but it is not a list, then you use the general nomenclature, which is subsection. So section 35, expenditure on scientific research. Subsection 1 states revenue expense is allowed as a deduction. Subsection 2 states capital expenditure is allowed as a deduction. The two of them are in a way unconnected to each other. One talks of revenue, the other talks of capital. Yes, both of them talk about the same thing, research, but one is independent of the other. Then they are subsection numbers. Giving you another example, section number 28, charging section of PGBP, is a list of incomes. So then it is clause number. List hai, so it will be clause number. House property chapter, if you remember your CA Inter, 24A, standard deduction 30% of NAV. 24B, interest on borrowed capital, interest on loan. What is it? It is a list of deductions that are allowed. Salary chapter, section 16, 16.1A, standard deduction, 16.2, entertainment allowance, 16.3, professional tax. List of deductions. When you are talking about list, you are talking about clause numbers. But section 35, research, 37.1, general deduction, 35 AD, capital expenditure on specified business, 48, computation of capital gains, 45, charging section of PGBP. All these are subsection numbers. In all these sections, you will have subsection numbers. General nomenclature that everybody understands is section, uske baad subsection, uske baad clause. So this is how it generally looks. Generally it is section, after that there is subsection, after that there is clause, After that there is sub clause. I am, just to give you an example, I might say, yeah, scientific research is the perfect one. 35 1 2. 35 subsection 1 clause 2. But if you are talking about a list wala thing, definition, exempt incomes, then it will be, I'm sorry, then it will be section, clause, subclause. Section 2, 1A, agriculture income, in that subclause A or subclause 1, depends on the numbering selected by Income Tax Act. So if you have clause, then automatically after clause there is subclause. If it's a list, so you will not have subsection, you will have clause. But if it's the general nomenclature, so after section you will have subsection, then you will have clause, and then you will have subclause. Chalo, I think this much is clear. So coming back to the starting point, income tax is total income into tax rates. Now, how do I get my tax rates? I come to know what my rates of tax are as per Finance Act. Slab rates are announced, surcharge etc. is announced, health education says, that is all as per Finance Act. But then beta yaad karo, income from lottery taxable at the rate of 30%. Where is it written? You will not find this in the Finance Act. You can scan through the entire Finance Act, you will not find lottery ka tax rate is 30%. That is given by section number 115BB. Long term capital gains. 115BB is the section of Income Tax Act, not of Finance Act. Income Tax Act ka section number. Now I am getting a rate of tax not as per the budget. I am getting a rate of tax as per Income Tax Act. Short term capital gain, section number 111A, 15% tax rate. Long term capital gain, section number 112, 20%. 112A, 10% without indexation. All these are section numbers of Income Tax Act. They are also giving me tax rate. So, who gives me tax rate? The general answer, Finance Act. But that's a general answer. So what is the accurate thing? By rates of tax are of two types. One, if the tax rate depends on the assessee based on the type of assessee, then these will be announced in the Finance Act. Nature of assessee, type of assessee changes, tax rate changes. Individual pays tax according to slab rates. Company, partnership firm pay tax according to a flat rate. Then that is assessee based rate of tax. That is given to you by Finance Act. But if the rate of tax is based on the nature of income, the type of income, short term capital gain, long term capital gain, winnings income, undisclosed income, then whether you are a company or a firm or an individual, you will pay tax at that fixed rate. Long term capital gain is taxed at 20% for company also, for individual also. Short term capital gain under 111A is taxed at 15% for individual also, firm also, company also, AOP also, HUF also, everybody. And so when they are income based, Income Tax Act 1961 gives you the rate of tax. So that does not change depending on the type of assessee. Whoever is the assessee, this is the income, look at Income Tax Act for the rate of tax. For all other type of incomes, assessee based. When you calculate your tax calculation is comprising of four things. One what I call as basic tax. Just to avoid confusion, I call it as basic tax. If you want the accurate nomenclature, accurate thing that ICAI uses, it says tax on total income. So just to differentiate, because our final answer is also going to be tax payable. So to make a distinction and to not to have any confusion, I say basic tax is my tax on total income. Then from this basic tax, there are rebates and reliefs that are allowed. Then you have surcharge, and then you have health and education cess, and this that you get, this is your tax payable in the assessment year. Of course, everyone knows, okay, this is the tax payable in the assessment year, but this is not the amount that I'll pay to the government. Whatever tax has been deducted at source, TDS, collected at source, TCS, advance tax, I will adjust all of that from this. Final amount is what I will pay to the government at the time of filing return, or maybe I will take that as refund from the government if it is refundable. Point is, okay, that thing is the extra or the extension of this formula. Broadly speaking, my liability of tax is this, from which whatever is paid is all adjusted, etc. Final amount is decided later on. This is the gross income tax payable, gross income tax liability. This thing, basic tax, this you calculate either as per Finance Act or as per Income Tax Act. What is the rate at which you will calculate your basic tax? Slab rate, flat rate, that is given by Finance Act, assessee based. But certain incomes, तो income based, Income Tax Act देखो. Rebates and relief, they are mostly given in the Income Tax Act itself. You might remember that if you are a very small taxpayer as an individual, you are earning income up to 5 lakh rupees only, so you get a rebate of 12,500. So this is the rebate that we are talking about. Surcharge, rates of surcharge are given by the Finance Act. Surcharge keeps on varying depending on the assessee. Companies have a different rate of surcharge, individuals have a different rate of surcharge. So Finance Act gives you that. Health and education cess is also announced by the Finance Act. If you read the Finance Act, health and education cess is an extra cess, an extra tax that they are imposing to provide universal education throughout the country. This is an extra amount that the government is collecting from us, which it is thereafter spending on education programs so that throughout the country a certain level of education can be provided. Of course, as somebody who is the taxpayer, it is an outflow for me. It is part of my income tax liability. So practically nobody bothers whether the money is spent in education schemes or not. Yes, there are auditors, Comptroller and Auditor General of India would be auditing all of that, but the common man is basically concerned about this is also part of my income tax, I have to pay this. Technically, as a chartered accountant, you should be aware of this. Okay, this amount is collected for this purpose. Like surcharge, why is this surcharge collected? If you are already collecting basic tax, why are you collecting surcharge also? So surcharge is basically this, SUR, SUR, that means I am talking about surplus. If you are having surplus income, charge, that means I am talking about charge of tax. You are supposed to pay surplus tax. You are having super duper income, your income runs into crores, then you are capable enough to contribute something extra to the government. You not only pay the basic amount, you pay an additional tax, super tax, surcharge is what's called. If whether you earn extraordinary income or regular normal income, basic tax is something that is payable by everyone. Again, I'll be a bit cautious here. Generally speaking, why am I saying generally? See, we all know that there is a concept of basic exemption limit. So if your total income is up to the basic exemption limit, so you're not supposed to pay basic tax also. So paying everything else does not arise only. So generally speaking, when I'm saying generally speaking, I'm saying okay, total income is above the basic exemption limit. How much above? Thoda bahut, little bit, or running into crores. Whether you earn super duper level of incomes or normal incomes, basic tax is what you are going to pay. But if you are earning extra income, then you will pay an extra tax also in the form of surcharge. And health and education cess is imposed on everybody. This is how you derive your tax rates. Now, moving ahead, I have to now discuss two things with you in order to bring an end to lecture number 1. Lecture number 1, the focus is on introduction, tax rates. So now I have to discuss two more aspects with you. See, I started with this one line, income tax is equal to total income into tax rate. Income tax is payable in the assessment year, total income is in previous year. We discussed what is a previous year, what is an assessment year. How is total income done? Calculation is done, there is a pattern. You have to take into account section 5, scope of total income, when you decide the amount of total income. So that section 5 is what I have to discuss with you in depth. In the balance part of the syllabus, I will hardly get any chance to formally discuss section 5 with you. And section 5 say related independent question never comes up. So it's better that in the first lecture only, I discuss section 5 with you in such a way that okay, it gets fitted up in your mind, that we know this, okay, section 5, remember permanently, now we can, in whatever part of the syllabus we are aware what section 5 is. That's one thing that I want to discuss with you properly. And then tax rate ka discussion, this thing, these 4 aspects. How to calculate basic tax and surcharge and health education cess. I've put it up in detail in the book only. So basically I have to just go through the textbook, make you understand what the rates of tax are. Some of you who are doing articleship in the field of tax, income tax basically, you are aware of what the rates of tax are. But then you could also be a student who has been doing articleship in the field of audit and you have been completely divorced from income tax in the last 1.5 years, completely away from income tax. So then it will act as a formality for a student, but then it is a necessary formality that I'll have to do, where I will discuss the rates of tax. And as a student, what I expect is that you permanently remember the rates as per budget. You are aware, you have seen it in CA Inter also. Okay, slab rates and all those things will not be given in the question paper. So you have to remember it and you must know how to apply it. So these two things I want to discuss with you in detail. One is your scope of total income, section 5, and then second, the rates of tax which are given by the Finance Act. Chalo, section 5. Scope of total income. Subject to the provisions of this act, the total income of any previous year of a person who is a resident. So subsection 1 talks about you being a resident. It does not say which type of resident. It does not say whether you are a resident and ordinarily resident, resident not ordinarily resident. It simply says who is a resident. So which means when I say resident, right now I am covering resident and ordinarily resident also, and I am also covering resident but not ordinarily resident. Everybody is a resident, both of them I mean. The total income of any previous year of a person who is a resident includes all income. Total income includes all income from whatever source derived, which is number 1, received in India, deemed to be received in India in such year meaning in previous year, by or on behalf of such person. So number 1, our basis of taxing the assessee is receipt. Number 2, accrues in India, deemed to accrue or arise in India. So one is talking about actual accrual or actually arising in India. The other is talking about deemed to accrue, deemed to arise in India. Like in point A, we were talking about actual receipt or deemed to be received. Here we are talking about actual accrual or deemed to be accrued, which means the second criteria of taxing an assessee is accrual. And remember, the word written is or. So either on receipt or on accrual, either on actual receipt or deemed receipt, actual accrual or deemed accrual. Third, accrues or arises to him outside India. So in point A and B, we were talking about things in India, and in point C, we are talking about outside India. But then subsection 1 says, okay, see, if you are a resident, so income accrues in India or is received in India or accrues outside India, you will include that in your total income. A, B, C, everything will be charged to tax. So as far as a resident is concerned, globally wherever you earn income, you will have to include it in your total income. In simple words, you will have to pay tax. Now there is a provided wala paragraph. What did I tell you? Provided wala paragraph means that there is an exception that is created. Provided that in case of a person who is not ordinarily resident in India, within the meaning of, sorry, this is not subsection 6, this is clause number 6. Section 6, clause number 6. In case of a person not ordinarily resident in India, so he is a resident, but he is not ordinarily resident. The income which accrues or arises to him outside India shall not be so included. Shall not be so included meaning shall not be included in total income, which means in simple words, it shall not be taxable in India. So if you are a resident but not ordinarily resident, then the income which accrues outside India shall not be included in your total income unless and until it is derived from a business controlled in or a profession set up in India. So if you are a resident but not ordinarily resident, then income accruing outside India is not taxable in India unless and until it is from a business which is controlled in India or a profession which is set up in India. Then the income is taxable. Even if it accrues outside, it is taxable in India. But if the business is controlled outside and the income accrues outside, so it's not taxable for a resident not ordinarily resident. Okay. Now, sir, what is this exactly? See, who are we talking about? We are talking about resident. Okay. So, I am discussing section 5. My assessee is a resident and when I say resident, I mean resident and ordinarily, and resident but not ordinarily. ठीक है? Now there are two bases by which I am going to tax the income. One is accrual, the other is receipt. Accrual gets divided into two further categories: accrual in India, accrual outside India. As far as receipt is concerned, section 5 simply says received in India. So we'll stick to received in India the way it is mentioned in section 5. Currently my focus is to make you understand something about the accrual. When I say accrued in India, I am covering actual accrual also, and I am covering deemed accrual also. So whether the income is actually accrued in India or deemed to be accruing in India, as far as section 5 is concerned, the income is taxable. If the income is accrued outside India, if the income is accrued outside India, now this is where we had that point number C, and then there was a proviso also. Point C is saying accrued or accrues or arises to him outside India is to be included. Then the proviso is saying that if you are a resident but not ordinarily resident, then it will not be taxable for you unless and until it is derived from a business controlled in India. So if the income is accrued outside India and I am a resident and ordinarily resident, then there is no problem only. If I am a resident and ordinarily resident, it is taxable for me. But if I am a resident but not ordinarily resident, then the general rule is it's not taxable. But then we said unless it is from a business controlled in or a profession set up in India. Business controlled in India, profession set up in India, 1 minute. So I am now thinking about the head of income called as profits and gains of business or profession. Now my income is from PGBP, business activity. And when I am earning income under the head PGBP, if the business is controlled in India, or it's not a business, it's a profession, so the words are not controlled, the word is set up, but the profession is set up in India. Please remember one thing, that the income has accrued outside India, so the transaction has happened outside India, but the setup of business, the control of business, the profession, everything that is in India. Now Income Tax Act is saying, by this will be taxable for you. You are a resident but not ordinarily resident. You are doing some business activity outside India, but the setup, the control is from India, so you pay tax in India on that income. Which implies that if I now tell you that the business is controlled outside India, or the profession is set up outside India, then do I fall in that proviso? What is the proviso saying? The proviso is saying that income will not be taxed in India unless it is derived from a business controlled in India, profession set up in India. So proviso is making the outside India income taxable in India only if the accrual is the control, the setup is in India. The proviso is making the outside India income taxable in India for this residential status only if the control is in India, the setup is in India. Now I am imagining a situation where the business is controlled outside India, the profession is set up outside India. So in that case, now this is not taxable in India. Chalo, I'll define the short forms later on. Let me right now write it in a very concise way only so that we can do things effectively. This will be not taxable in India. And remember, by the proviso is only talking about business wala income. So what if this resident but not ordinarily resident earns capital gains, earns IFOS income, earns salary income, earns house property income? I am talking about the other 4 heads of income. Does the proviso come into picture for the other heads of income? No. Proviso is only talking about income accruing outside India, business activity, professional activity. So as far as the other 4 heads of income are concerned, proviso has very clearly said not taxable in India, not to be included in the total income. So this is not subject to tax in India. See this. Now this might give you a better picture. Where is the income accrued? If it is in India, it is taxable. Without a shadow of doubt, it is taxable. Accruing in India. Deemed to accrue in India. Deemed to accrue is covered by section 9. Certain incomes are deemed to accrue in India, assumed to accrue in India. Taxable in India, obviously. If actual accrual is taxable, then deemed accrual is also taxable. If your income actually arises outside India, but because you are a resident, you have to pay tax. Now if you are a resident but not ordinarily resident, then this one small exception is created. And I'm sure you'll understand one more thing. You'll agree with me on this also. Beta, this exception, this proviso wala thing, that is only for point C, na? The income which accrues or arises to him outside India, that's only for point C. The proviso is only for point C, not for point A and B. That means for A and B point, section 5, subsection 1, clause A, clause B is applicable for both residents. What is clause A? Received or deemed to be received in India. When I am talking about, look at this second part of the chart. Receipt in India, when I am talking about this part, receipt in India, this one, this, the one that I am zooming in. This receipt can be actual received in India, or it can be deemed to be received in India. Deemed to be received in India is defined in section number 7 of Income Tax Act. Then to whoever you are, it does not make a difference. By this income is going to be taxable for you. You are a resident, you have received the income in India, so it is taxable. The word T means taxable in India, and the word NT means it is not taxable in India. In fact, if you have been paying attention, you have also understood one thing, that I am saying taxable in India, not taxable in India. The focus is in India. This section 5 is helping me to understand scope of total income. That's what the section's heading is, na? Scope of total income. But scope of total income means what? It means whether the income is taxable or not taxable. Where? Not globally. India, na? India ka Income Tax Act 1961 can only prescribe whether it's going to be charged to tax in India or not. It can't prescribe it globally. Okay, whatever we say in section 5 has to apply to all countries. Obviously not. That is silly. That is stupid. So When we are studying section 5, we are focused on whether this will be taxed in India or not taxed in India. In India. Now, there is one more thing which I am pretty sure somebody would have thought. Sir, in this situation, income is accruing outside India, but you are saying it is taxable in India. Sir, in this situation also, it is taxable in India. Bottom line is still, it is accrued outside India. Accrued outside India. Taxable in India. But sir, that means if it is accrued outside India, the place where the country where that income is accrued, they will also tax me. In fact, you would have understood also what I am hinting at. I am talking about double taxation happening. Definitely double taxation is possible. Section 5 is saying it will be taxed in India. So, taxed in India as per section 5. But if it accrues outside India, so it is taxed in that country also. That is called as source country. Source, that's the source of income, that's where the income arose, the income arises. Source country. Taxed in the source country, yes, as per that country ka Income Tax Act. So now, is there double taxation happening? Yes. Should you pay tax? Yes. Please listen to me carefully. Should you pay double tax? No. But should I pay single tax? Once so I should pay tax, na? Obviously yes. Here to what is happening is, India's Income Tax Act is applying and making it taxable. That country ka domestic tax law applies and it's making that also taxable. What to do? Yes, there is double taxation happening. And if you remember, this is my solution. Double Taxation Avoidance Agreement, DTAA. Double Taxation Avoidance Agreement. It is a agreement to avoid DT, double tax. So the solution is there. The problem is two income tax laws, one of India, one of that country, are simultaneously being applied on that same income for the same assessee. So he is supposed to pay tax on the income but not double tax. So if he is supposed to pay tax, here though we are having double taxation. Don't worry, we have a solution for it. Whenever there is a double tax that is happening, DTAA, Double Taxation Avoidance Agreement, will prevent double tax. So you will pay tax, but you will pay tax at the end only in one country. Now you know it's part of our syllabus, so I am not elaborating it right now. I am just presenting a problem and telling you there is a solution existing for it. It's a separate chapter to study. So when we do international tax, we'll study it at that point of time. This is section number 5, subsection 1, which only talks about a resident person. You've actually done the tough part. Now when you look at 5 subsection 2, you'll realize, okay, this is way too simple. Section 5 subsection 2. Subject to the provisions of this act, I am reading this. Subject to the provisions of this act, the total income of any previous year of a person who is a non-resident, includes all income, we are saying if you are a non-resident, in India, the following incomes will be included in your total income. The following incomes will be taxable for you. Which ones? Received in India, deemed to be received in India, accrues in India, arises or is deemed to accrue or arise in India, and that's it. Point C is not there. Point C was there in subsection 1. Income accruing outside India was taxable for you in India if you are a resident. And if you are a resident but not ordinarily resident, only in one case it is taxable. So I'm not getting into it once again. But what I am saying is A and B of subsection 1 is the same in subsection 2 also. But subsection 1 may C point is there. Subsection 2 may C point is not there. That means, okay, by if you are a non-resident, when I am talking about section number 5, subsection 2, and who is my assessee? My assessee here is a non-resident of India. And if I try to draw the same type of chart, the one that I just drew for 5 subsection 1, I'll say income, accrual, receipt. As far as receipt is concerned, section 5 has said received in India. So by if the income is received in India, naturally, obviously the income is taxable in India. If the income is accrued, so now I have two possibilities: accrued in India, accrued outside India. I am following the same pattern. If you observe, I am basically following the same pattern. Dekho, accrual in India, accrual outside India, same pattern. But non-resident ka chart will be actually much simpler, because if I am talking about accrual in India, it can be actual accrual, it can be deemed accrual. But by actual accrual or deemed accrual, whatever it is taxable. And when you talk about income which is accruing outside India, PGBP, non-PGBP, all of that was because there was point C in subsection 1. Here there is no point C. So here, whether it is PGBP income, non-PGBP income, does not matter. It's not taxable only. So business control in India, business setup in India does not matter. For a non-resident, the moment you earn income outside India, whether it is business, non-business, setup in India, setup outside India, control in India, control outside India, salary income, house property income, the moment you use the words non-resident outside India, it's not subject to tax in India. It's not subject to tax in India. Section 5 does not apply only. This same thing in a more proper, a more detailed way, I've put it up in the textbook after section 5 in the form of a table. Some students are comfortable with the table. The table contains a list of incomes and what is the situation for the 3 residential statuses. Some students understand it via this chart form. So I have drawn the chart also, and the table is anyways there in the book. All these handwritten notes, by the way, that I am currently writing on the screen, if you want you can copy them down, but I will be sharing a PDF of this also with you. So as a student, when you're watching the lectures, you can take the open the notebook and copy down all of this, or you can just focus on the lecture. The PDF is ready available with you. After doing all the proper refinement, I'll upload the PDF on a Google Drive link, and you can download the PDF from that Google Drive link. Study from the PDF. Textbook hard copy is there with you. PDF is there with you, and you can just focus on listening the lecture, correlating the two, understanding it. Then you can make your extra notes if you want to. So your effort can get reduced in this vast subject. Your effort can get reduced if you decide not to copy down all these things that I am writing with you, because I am anyways giving the PDF to you. You might not spend another 1.5 hour in copying it down, but you can just write down small observations that you yourself are thinking, and it clicks you, and you feel this is also something that I should write down. That is what you have to do. So your effort of writing down will get reduced. You can just focus on the lecture, understand all concepts. If you feel something is better than what I have spoken and it fits up in your mind, you can just take down that as notes rather than writing down all this stuff, because all this stuff anyways I'll give it to you in soft copy form in that Google Drive folder. I'll put up a link and you can download it. So this is my section number 5. Section 5 also has these two explanations, something pretty obvious. Explanation 1: income accruing or arising outside India shall not be deemed to be received in India within the meaning of this section only by reason of the fact that it is taken into account in a balance sheet prepared in India. Just because you have prepared a balance sheet in which you have taken into that foreign bank account is one of your asset, and then it does not mean that the income is received in India. Or for example, if there is a subsidiary company which has received income outside India, but when the holding company prepares consolidated statements, it includes that subsidiary ka bank account also. So in the consolidated financial statements in the balance sheet, that bank account, those incomes are included, but that does not mean that the subsidiary has got the money into India. The money is received outside India, money is there only. It will not be taken as received in India, and the subsidiary will not be told to pay tax just because the holding company included it in the consolidated statements. Explanation 2: it is hereby declared that income which has been included in the total income of a person on the basis that it has accrued or arisen or deemed to accrue or arisen to him shall not be again so included on the basis that it is received or deemed to be received in India. Now this is pretty common sense. If I have already asked my assessee to pay tax on accrual basis, then on accrual, if receipt after accrual, if receipt happens, I will not tell the assessee to pay tax on receipt again. If the income accrued on say 23rd March 2023 and it was received on 6th of May 2023, so this is previous year 22-23 and this is previous year 23-24. Now I have already paid tax on accrual basis. When I receive the money in the next year, I am not going to pay tax. This is pretty common sense. This is clarified for the removal of doubts. It is clarified that this is how it is going to be. So there is no confusion, there is no interpretation, nothing left to any interpretation skills. This is what it's going to be. This is your section number 5. This is the one thing that I wanted to discuss with you. And now the second thing I told you, rates of tax. Now rates of tax, what we will be discussing right now are only those rates of tax that are as per the budget. So all those rates of tax which are income based, short-term capital gain, long-term capital gain, winnings income, income which is undisclosed, all those special income tax rates we will discuss as and when we take up that particular chapter, and we will study that chapter, study that income and discuss the rate of tax also. So when we study capital gains, we will at that point of time study short-term and long-term rate of tax. Right now I am talking about general rates of tax. Rates of tax which are announced as per the budget, which apply to salary income, house property income, PGBP income, IFOS income, not those special tax rates. Tax rates that I am doing as per the Finance Act, they are assessee based. So it becomes very convenient if you think from an assessee's perspective. Who is the assessee? And according to that you understand the rate of tax. Now see, first assessee, individual. How does individual pay tax? According to slab rates. 2020 का budget, a section was introduced 115 BAC. Many of you will be aware of this section by way of something called as new tax regime. These are concessional slab rates. So they are lower slab rates as compared to the ones that are announced by the budget. But if you want to apply lower slab rates, then those lower slab rates, they are applicable on total income. But this total income is not the same total income that we calculate normally. This total income is without giving you deductions, without giving you exemptions, without giving you chapter 6A deduction, without giving you the benefit of set off carry forward of losses. So income automatically goes up. If deductions are not given, exemptions are not given, set off carry forward benefit is not given, obviously income will increase. So rates are lower, concessional rates, but income is calculated on the higher side. There are 4 sections: 115BAA, 115BAB. These are 2 sections that are applicable for domestic companies. 115BAC, which is applicable to individual, and 115BAD, which is applicable to resident cooperative societies. In one simple word, I would say they are concessional tax rates. So these concessional tax rates, these tax rates that I am talking about, we will be able to study them only after we have studied the first part of our syllabus, that is the computation part. Because when you are paying tax as per concessional tax rates, certain exemptions, deductions are not allowed to you. Now, if those exemptions, deductions, etc. are not allowed to you, that means when you are doing this computation and it's not allowed, you need to know now first which deductions are there, how are they allowed in the normal course, and what will happen if they are not allowed. So these 4 sections, 115BAA to 115BAD, we will be studying them later on. After we have done all heads of income, after we have done chapter 6A deduction, we will pick up this concessional tax rate wala chapter and we will study all these 4 sections. It will take about 1.5 lecture and we will study these 4 sections, all complications possible. We will solve questions also based on it, but that will be done later on. So as of now, this part 115BAA to BAD, this part, wherever this appears, I am not going to discuss it. I am keeping it pending, but I am deliberately keeping it pending to be discussed later on. So if you are an individual, you are going to pay tax according to slab rates. What are my slab rates? If I am 60 years or more but less than 80 years at any time during the previous year, not assessment year, previous year. So when I am earning income, if I am 60 or more but less than 80, I have a basic exemption limit of 3 lakhs, no tax up to 3 lakhs. Then from 3 lakh to 5 lakh, 5% ka tax rate. From 5 lakh to 10 lakh, on that income 20%, and income about 10 lakhs 30%. If I am 80 years or more at any time during the previous year, my basic exemption limit is 5 lakhs. I am not paying any tax up to 5 lakhs. 5 to 10 lakhs 20%, about 10 lakhs 30%. And all other cases where slab rate applies, basic exemption limit of 2 lakh 50, then 250 to 5 lakh is 5%, 5 to 10 lakhs is 20%, and about 10 lakhs is 30%. If I am a resident and 60 or more but less than 80, so say for convenience, we'll call this first person as a senior citizen, but you have to be a resident senior citizen. In this second also the word is resident, but you are 80 or more, so let's say I call that as a super senior citizen, but you must be a resident. So if you are 63 years and a resident, you fall in the first slab, basic exemption limit of 3 lakhs. 83 years and resident, basic exemption limit of 5 lakhs. 83 years and non-resident. 63 years and non-resident. 33 years and non-resident. Others. 33 years and resident, still fall in others. So all my non-residents, whatever be my age, they are covered in the others category. 60 or above, 80 or above, below 60, but you are a non-resident, others category, basic exemption limit of 2,50,000. If you are a resident but below 60, then also you are falling in the others category. These are your slab rates. Now, something very interesting. Refer circular number 28. The interesting part is something like this. What if somebody is born on 1st of April? You are born on 1st April. So, if you are born on 1st of April and say for example 1st April 2022 is your birthday, and you have, for instance, you have completed 38 years. So you are stepping into the 39th year of your life. So you have not completed 38 years on 1st April. You have completed 38 years on 31st March. 39th year begins on 1st April 2022. 1st April 22, my 39th year begins. 31st March 23, I will complete 39 years and I will on the next day start the 40th year of my life. Sir, why is this so necessary? It is necessary because suppose you complete 60 years of your age on 1st April 2023. So that means 60 years are not completed on that day. Your birthday is 1st April. Your 60th year is completed one day before it. And if you observe, at any time during the previous year, at any time during the previous year, if you are 60 years or more, so for that previous year, you are a resident, senior, resident depending on your stay, but you are a senior citizen. If my birthday falls on 1st April 23, then I am not becoming 60 years ka age on 1st April 23. Nah, I am attaining the age, I am completing 60 years on 31st March 23. And 31st March 23 falls in previous year 22-23. So I will be entitled to the benefit of basic exemption limit of 3 lakhs for previous year 22-23 only. Not previous year 23-24 onwards. 23-24 mein to definitely I will be a senior citizen, but I am completing 60 years one day prior. Similarly, one day prior, if I am celebrating my 80th birthday on 1st April 2023, it means I have already completed 80 years one day prior. So this is what that circular tells you. Now, coming back to our discussion, basic tax is calculated on slab according to slab rates. Rebate, you are getting a discount. What is the discount that you are getting? This is available only if you are a resident individual. Number 1, you must be a resident. Number 2, you must be an individual. If you are a company, if you are a firm, rebate is not available. Only available if you are an individual. That too if you are a resident individual. If you are a non-resident, rebate does not apply. If you are a resident individual and your total income does not exceed 5 lakhs, so you are a small taxpayer. You are a small taxpayer, your income is 5 lakh rupees or less than that, and you are a resident individual, then we will give you a discount. Basic tax, which is this amount. or maximum rebate of 12,500 out of the two, whichever is less. So if you are a non-resident, no rebate. If you are not an individual, no rebate. If you are a resident individual but your income is above 5 lakhs, why do you need a discount? You are capable enough to pay the tax. No discount, no rebate. Add surcharge. Now, surcharge calculations. Two types of surcharge calculations. One, where your total income does not include short-term capital gain under section 111A, long-term capital gain under section 112A, dividend income, and as per our budget now, even long-term capital gain under section 112 is now covered. In the entire textbook, wherever you see this type of red print and in a different font, that is the amendment. In the entire book, wherever there is an amendment introduced, I have put up that amendment and put it up as a paragraph or some words are there, but I have changed the font and I've put it up as a red color in terms of the ink. See this. So that indicates that okay, this is an amendment. So what's the amendment here that I am discussing with you? Here I am talking about surcharge. Now if you have short-term capital gain under 111A, long-term capital gain under 112A, 111A and 112A are talking about listed equity shares, mutual fund units. So there is a lot of foreign investment, and for those type of capital gains, we are restricting the rate of surcharge to 15%. When you observe the rate of surcharge, normally the rate of surcharge under normal circumstances is 10%, 15%, 25%, 37%. But if your income is 111A wala short term capital gain, 112A wala long term capital gain, then we will not charge you a surcharge of 25% and 37%. We will charge you a surcharge of 15% fixed surcharge. This was done to to satisfy those foreign investors. When originally this high rate of surcharge was introduced about 2 years ago or 3 years ago, 3 years actually, prior to COVID this had happened. The moment government introduced in the finance bill 25% and 37%, all these foreign investors, they were very unhappy. 37% ka surcharge. So you pay basic tax, you pay 37% surcharge, and then you pay 4% health education cess also. Everything increases to a great extent. The tax rate goes to a huge percentage. So then they said, no, Government of India, we are not happy with this. If this is what happens, we will withdraw our investments. So government said, no, foreign investment getting withdrawn globally will have a very bad impact. So they said, okay, ek kaam karo. Even if your income goes above 2 crores, above 5 crores, don't worry, we will not charge you 25% and 37% surcharge. But then irrespective of the amount of income, you pay a 15% surcharge fixed. Below 50 lakhs, above 50 lakhs, below 1 crore, above 1 crore, above 2 crore, below 2 crore. Don't then look at those limits. You are earning short-term capital gain, long-term capital gain. Instead of 25-37%, pay 15%. Now those foreign investors, their capital gain always was running in crores only. Foreign investors, say a particular foreign investor, a company or an individual, they are investing only, let's say 3 crores, and then they are selling it for 4-5 crores. So their capital gain only is 1 crore, 2 crore. Anyways, the gain was above 50 lakhs, above 1 crore only. So they were paying a surcharge of 10%, 15% always. Now with this new 25 and 37%, they became very uncomfortable. So we said, okay, we'll give you the benefit. We'll not apply 25-37%, but you will pay a 15% surcharge on the taxes on these incomes. Now, last year, even dividend income was included in this list. And current year, section 112 wala long-term capital gain is also included in the list. So all these things that I discussed with you right now, that is our part 2. If my total income includes this capital gains and dividend income, then my surcharge is calculated in a slightly different way. So once I discuss the chapter of capital gains with you, once I discuss the chapter of IFOS, dividend income is IFOS, after that we will discuss part 2. Part 2 as of now is pending. Currently, let us study the surcharge rates that are applicable to an individual, assuming these incomes are not there. So the person is earning salary, house property, PGBP, IFOS income other than dividend. If he is earning capital gain, it is not short term under 111A, it is normal short term gain, it is not long term capital gain. He is earning normal incomes. Then up to 50 lakhs, no surcharge. Above 50 lakhs, your income arises above 50 lakhs, but up to 1 crore, whatever basic tax you are calculating, 10% of that is your surcharge. Above 1 crore, up to 2 crores, 15%. Above 2 crores, up to 5 crore, 25%. Above 5 crore, 37%. 50 lakhs, 1 crore, 2 crore, 5 crore. Above 50 lakhs, 10. Above 1 crore, 15. Above 2 crore, 25. Above 5 crore, 37. These are my surcharge rates. Surcharge will always be calculated on basic tax. Health and education says 4% of basic tax minus rebate plus surcharge. So these are my tax rates applicable to an individual. Now, if I am, and I've already told you that this capital gain getting included in the total income surcharge calculation becomes complicated. We are going to do it, but not in the first lecture. Let us first study capital gains and those special tax rates in depth, and then we'll study those surcharge rates also. Now, if I am a HUF, then 115 BAC is an option available to HUF also, concessional tax rates, but I've already told you I'm going to keep this pending. So this stuff is pending. HUF normally will pay tax according to slab rate. Now HUF is not a senior citizen or a super senior citizen, Hindu undivided family. So obviously the basic exemption limit applicable will be 2,50,000. Surcharge same as applicable to individual, 50 lakhs, 1 crore, 2 crore, 5%. So 10%, 15%, 25%, 37%. Income, total income is above 5 crore, 37%. Total income is above 2 crore but up to 5 crore, 25%. Above 1 crore but up to 2 crore, 15%. And above 1 crore, 10%. Health education says 4%. That's the same for everyone. This is HUF. Artificial juridical person, same as HUF only. Basic exemption limit 2,50,000. Surcharge is same, 50 lakhs, 1 crore, same thing. Health education says 4%. Artificial juridical person, 115 BAC is not applicable. 115 BAC is only for individual and HUF. It's not applicable for artificial juridical person, so therefore I just put it out separately. Partnership form, local authority, a flat rate of 30%. 30% tax. What? No basic exemption limit. No concept of basic exemption limit. Whether you earn 10 rupees or 10 crore rupees, you will pay tax at a flat rate of 30%. If your total, this is the simplest surcharge thing. If your total income is up to 1 crore, no surcharge. If your total income is above 1 crore, surcharge is at 12%. Now above 1 crore, how much? Any amount. Above 2 crores, 5 crore, whatever, 5, 10, 15, 35, 40 crores. If the total income is above 1 crore, surcharge will be at the rate of 12%. Health education says 4%. AOP BOI, we are going to study it separately in the chapter of AOP BOI. If you remember our syllabus discussion, other topics, there is one thing as AOP taxation. So we are going to discuss that AOP taxation, in which we'll discuss tax rates. Now comes our last assessee, company. I have already told you domestic company gets this concessional tax rate 115 BAA and BAB, but we are going to discuss that much later in the syllabus. For a domestic company, a lower tax rate of 25% will apply. But if you want to avail of that, then your turnover or gross receipts for previous year 2021. By what's our previous year? Our previous year is 22-23. Go back 2 years and check what was the turnover, what was the gross receipts. Not your total income, not your net profit. P&L account, credit side, turnover. And if you're not doing sales, etc., but you are providing some services, then you will not have the word turnover, then the word will be gross receipts. 2 years ago, this is the statement of profit and loss 2 years ago. If this figure is less than or equal to 400 crores, then today you will pay tax at 25%. Today you will pay tax at 25% on the turnover 2 years ago. Nah. You will pay tax on total income. Total income of which year? Previous year 22-23, assessment year 23-24. So on current year's income, the rate of tax is being decided based on the turnover existing 2 years ago. Sir, why this? Two parts of the discussion. First, India is one country where the corporate tax rate, company taxation, is much higher when you compare it globally. Singapore has, I think, in single digit. Mauritius has maybe, I think, 12 or 15% tax rate on companies. UAE also has much lower tax rate. More developed a country, less it has to rely on taxes, because it is having other avenues of inflow. Tourism is there, exports are there, so it has to rely less on income tax from its citizens and companies and corporations, so rate of tax is lower. Every country which is more developed than India, you can observe rate of tax is lower. You can Google it, you can find out. Japan, Singapore, Mauritius, US, UK of course now you don't know because of the current situation what happens, but you will find tax rates generally in more developed countries, Saudi, Israel, is much lower. If it's a developing country, it needs money, and because it needs money, it has to tax its citizens. India, today you are having a basic exemption limit for individual as 2,50,000. When I was a student and when I was studying, at that point of time, I'm talking about a time of 2007-2008. So that is 15 years ago, of course. 15 years ago, the basic exemption limit was 2 lakh rupees. If you go 2-3 decades earlier, the basic exemption limit, you will find 80,000, 90,000. The income levels were also not that great. So as a developing economy, you need more tax, lower exemption limits, higher tax rates. Companies in the past have paid tax at 60-70% also, 40-50% also, domestic companies. Then the tax rate slowly reduces. The corporate sector has been consistently pressurizing Indian government to reduce the tax rate. So government came out with this solution. Government said, if 2 years ago your turnover is less than or equal to 400 crores, then today you pay tax at the rate of 25%. Otherwise you pay tax at the rate of 30%. So the rate of tax which was 30% has been brought down to 25%. But for this the criteria is go back 2 years. Now sir, why go back 2 years? See, it's very common sense. Suppose the government says you check the turnover in 22-23 only, current year only. Check the turnover in the current year 22-23 and accordingly decide whether it is 25% or 30%. Then all companies will start doing manipulation in their books of account. Some sales will be there, but they might show it as advance received from customer or sales return. Even when sales return might not have been there, they might start showing fake things. They would manipulate their sales to reduce it below 400 crores, so that instead of 30 they have to pay tax at 25% current year only. So government obviously will not create this provision. Then you might think, okay sir, why did the government go back 2 years? Sir, we understood why they have not taken current year as a base, but then why 2 years? They could have gone back 1 year na? Nahi. If you understand previous year assessment year ka concept, you will understand this also. If the government says 21-22, so they've already sold goods etc., done the transactions in 21-22, and now we are in the next year 22-23. First 3-4 months statutory audit is happening. Everybody understands, okay, if we bring this turnover below 400 crores by doing some accounting manipulation etc., then in the next year 22-23, when we will be earning income and paying tax, we would have already manipulated our accounts and brought it to 400 crores or below that, and we can still avoid tax because you are in 21-22, you've sold the goods. But next year when you are finalizing your statutory, when you are doing stat audit and when you are finalizing accounts, you are already aware at that point of time that tax rate will be 25% in future. So accounting manipulation is still possible here, but it's not possible. It is not possible to manipulate any accounts like this. 2021 financial year, audit etc. would have happened, stat audit done, auditor report signed in 2021 June, July, May, April. So then in the next financial year 22-23, there is no scope for any manipulation. You've already submitted to ROC, and that's the reason government is going back 2 years. It's not taking the current year as a base, it's not taking one preceding year also, it's taking 2 preceding years. So it's not possible only for the domestic company to make any manipulations, to do any changes. 2 years ago, whatever was the turnover, that is freezed, that is finalized in your final accounts. If that turnover is less than or equal to 400 crores, then today the domestic company is supposed to pay tax at the rate of 25%. Otherwise, you pay tax at the rate of 30%. So if you are a company that large, where you are having turnover above 400 crore, Reliance Industries Limited, Infosys, all group companies of Tata, Bajaj, their turnover runs into thousands of crores. So yeah, their turnover runs into thousands of crores. Current year also, 2 years ago also, they are capable enough of paying tax at the rate of 30%. A company like Reliance Industries Limited will have a turnover of 7, 8, 9,000 crores. Its total income will be 50, 60, 70, 80 crores. So yeah, it is possible for them to pay 30% tax. But small companies whose turnover 2 years ago was 1 crore, 20, 30 crores, 40, 50 lakhs, they will get a benefit that you will just have to pay 25% of your total income as tax. And if you understand maths, you'll understand that this is not just a gap of 5%. This is not just a difference of 5%, 30 and 25. It's not just 5% ka difference. This will impact your surcharge calculations also, because surcharge is calculated on basic tax. Instead of 30, if your basic tax is 25, so surcharge also gets reduced. Then it will have an impact on your overall tax effect also. Na? So it's not just a 5% ka benefit. The benefit is much more than 5%. Chalo. Surcharge calculation, if the total income is up to 1 crore, no surcharge. If it exceeds 1 crore but does not exceed 10 crore, 7% of the basic tax obviously. And if it is above 10 crore, 12% of basic tax. Health education cess of 4% will always apply. This is for your domestic company. And last thing, foreign company. Foreign company, most cases your residential status will be non-resident of India. There is a separate discussion that we are going to do, but this thing that I am writing is very generally. Generally it's going to be non-resident. Now you are a foreign company and you are a non-resident generally of India, but if you are still having total income, so obviously this total income will be comprising of income which is accruing in India. We saw that in section 5. And if the income is received in India, then that is part of your total income. You have to pay tax in India on these incomes only, and you will pay tax at the rate of 40%. What is your turnover 2 years ago? We are not concerned. It's a foreign company. It could have turnover in India, it could not have turnover in India, but could have global turnover. In India, it might not be earning PGBP income by way of turnover, it could be earning some other incomes also 2 years ago, etc. So I am not giving any benefit, any concession. I am making it very simple. You will pay tax at the rate of 40%. Domestic company, the basic rate was 25% or 30%. Foreign company, the basic rate is 40%. For a foreign company, basic rate is higher. And you will observe surcharge percentages are lower. Up to 1 crore, no surcharge. Above 1 crore, but up to 10 crore, 2%. Above 10 crore, 5%. If you make a comparison, for a domestic company, this was 0, 7% and 12%. But for a domestic company, this basic was either 25% or 30%, and 4% health education cess is common for both. So when you do this comparison, you will realize that foreign company basic rate is high, 40%, surcharge rate is low, 2% and 5%, strictly comparing percentages. Domestic company 25-30%, basic rate is lower, surcharge is high, 7%, 12%. Criteria of surcharge is still the same. And if you pick up a calculator and do your mathematical calculations, finding effective tax rate 25% plus surcharge plus health education cess, and then compare it with foreign company 40% plus surcharge plus health education cess, keeping the income for both the companies same, you will find, suppose you take the income as 3 crores. So 3 crore pay, how much tax will a domestic company pay and how much tax will a foreign company pay? You will find that foreign company effectively will pay more tax because its basic percentage is 40%. So effectively foreign company is going to pay more tax. These are your tax rates. Individuals, slab rate. If I do go for a quick summary, then I could put it something like this. It's kind of very crude, very nothing systematic. It's just a quick summary that I'm giving you. Individual, HUF, artificial juridical person, you will pay tax according to slab rates. Partnership firm, you will pay tax at a flat rate of 30%. By the way, this partnership firm includes a LLP also. If you are a domestic company, 25% or 30% depending on the turnover 2 years ago. If you are a foreign company, 40%. Health and education cess will be applicable to everybody at the rate of 4%. Surcharge, so for individuals the threshold is 50 lakhs. For partnership firm the threshold is 1 crore. For domestic company and foreign company you have 1 crore and 10 crore, two thresholds. For individuals it is 50 lakhs, 1 crore, 2 crore, 5 crores. Four types of surcharge percentages are given, broadly speaking. And one more thing to mention, if you are an individual, so you will get a rebate. partnership firm, domestic companies, foreign companies, you are not entitled to any kind of rebate. So this is my summary of tax rates. We'll call it a day here. Tomorrow when we go to our next lecture, I will discuss one concept of tax rate with you, which is marginal relief. That is one thing relating to surcharge, but I'll discuss that marginal relief wala concept with you, and after that marginal relief wala thing, which will take 30 minutes, 35 minutes or so. We'll then begin with our first head of income, the head of income of capital gains. We'll first study the introductory part of capital gains. That's the first head of income that I generally discuss with the batch. So relating to surcharge, the marginal relief concept is our next lecture, and then we will begin with our first head of income, capital gains. I'll see you in the next lecture. Chalo, bye bye. If you have liked the lecture, so please hit a like button, share it with your friends, subscribe kar lo to the channel. See you. Bye bye.